All right. Thank you everyone for joining today's webinar. We're not right at noon. I'm late, so it's apologies on that. We'll give it one more minute until we get started. So thank you for being here. Sorry for being a little bit later than normal. And if you need to go run to the bathroom or grab a cup of coffee or anything before we get started, please do so now. All right, I'm going to call that a minute. So again, thank you everyone for joining today's webinar. My name is Matt Moore. I do business development here at Camaplan, Self-Directed IRA. In a little bit, we're going to hear from Roberta. She's going to introduce herself and talk about some passive income strategies. Before we get into that, though, I'm going to put our obligatory disclaimer here. So this is a presentation is for educational purposes only. Camel does not provide any investment or tax advice. So if you are going to go make any decisions that will investment decisions or decisions that are going to impact your taxes, please do your due diligence and seek out the guidance from the appropriate professionals. Also, housekeeping item, our chat will be turned off, but you will be able to ask questions through the Q&A feature. So please do that. It's just going to be on your Zoom menu. So don't be shy, ask questions. Let's keep this as a dialogue. I'll watch those and pass them along to Roberta as she's presenting. And then lastly, if you have any questions that don't get covered on today's webinar, or you have a self-directed IRA question, Roberta could actually help you with that too, because she's a self-directed IRA expert. But I'd be more than happy to also answer those questions and tell you more about Camaplan and how we can help facilitate your IRA investments. So without further ado, Roberta, I'm going to stop sharing my screen
Okay.
and
Thank you, Matt.
I can see your screen. So the floor is yours.
Okay, great. Well, welcome everyone. Thank you so much for taking time out of your day to learn a little bit more about passive income strategies with Invest IRA. And Matt does know that my background is self-directed IRAs. And so with that experience, I have traveled the country. I've been trained by the best of the best, one of the largest custodians out there. And I educated investors just like you and me how to use a self-directed IRA, how to take that old 401k and get that money working for you in alternative investments. And in that experience, while I learned a ton and I had the opportunity to become even more of an expert and better at what I do, I found that investors like you and I really kind of fall through the cracks. And that's because they are learning from the custodian, they're learning from the investment sponsor, and often they don't quite connect that process, or they get excited, open the account, get it funded, and then they do not know what to do with it. And I had the same experience. I worked in this industry and also did self-directed IRA investments. And, I followed the herd, and sometimes I got hurt, and it was a little painful because I just didn't do the work. So, out of that frustration, and then also having an inside view, moving from the custodial seat where there's a lot of compliance, right? So, we're not here for that tax legal investment advice. However, I moved to working with investment sponsors and raising money. So now I'm moving from investing and raising funds in real estate and private equity. And I got the inside view into raising over $50 million plus in the oil and gas industry. And from that experience, I said, you know what? I think I can put this all together. So I created Invest IRA. And basically, what I do is I'm an unbiased advocate, a third party that can have that conversation with you individually as an investor and talk about all the things that Matt really can't go into, right? The feasibility before you actually make that investment, not just the feasibility for the self-directed IRA, but even the performance and the people behind that investment. So that's what I do with Invest IRA. And today we're going to talk about specialty medical finance. And I want you to think of this as a line of credit. I want you to think of yourself as being the bank and being paid very well to be the bank to provide specialty medical finance to medical service providers. And we're going to talk about the hard asset. We're going to talk about the collateral and a little bit about the team that I met back in 2020. So this is a company sponsor client relationship that I have watched grow exponentially since 2020. But of course, they got started back in 2014, and I'll talk a little bit about that. First, I'm going to touch on the industry itself and the problem that's out there. So some of you, and of course, I don't have a live audience, so I can't necessarily see the hands raised and all those good things. But some of you may have been in an auto accident, and this can be a pretty stressful situation. And really, this is where this story begins and how we offer an investment opportunity in this space, and it's called the personal injury medical industry. And what happens is in no fault states, and there's 14 of those, when there's an auto accident, uh, often there's two people that are injured in the accident, but in a no fault state, nobody is cited or at fault at the site of the accident. So the individuals go to the hospital, the chiropractor, the surgeon, whatever that might be, they're treated. The medical service provider actually bills that service, and we know that it is overbilled. That is the design of the industry and insurance. And it is billed out by that medical service provider. However, they are often not paid for 3 to 4 months and sometimes up to 3+ years. Now, for those of you that are real estate investors, I want you to think about this. Let's pretend that you have 100 doors and 80% of those doors or those tenants are not paying. That's a pretty critical problem, right? You would not be in business very long, and you may be giving that asset back to the bank if you don't have those tenants paying. So this is a similar scenario for the medical service provider. Because in those no-fault states, the personal injury receivable, accounts receivable, is the most valuable asset that that medical service provider has, and it can also be up to 80% of their receivables. So that causes a bottleneck, basically. We're talking about a $60 billion industry where this problem or this bottleneck occurs. And what PFD is able to do is extend a line of credit to the medical service provider and often settle those cases much, much faster. So what do I mean by that? So in this lifeline that we are able to extend, we have a bank and it's called our investors. So people like you and I, individuals that invest, and we extend that line of credit to the medical service provider so they can go back to being doctors, right? Rather than collectors or managing relationships with personal injury attorneys. And we basically lock arms with that medical service provider and we go to work in the settlement process, statusing those cases by case number on behalf of the medical service provider. We do not take over their relationships with their personal injury attorneys where they get their referrals. We don't take over their patient relationships. We are literally a bank extending that line of credit. And that way, we are able to accelerate the settlement process. The investment that you potentially would be making is in an entity where we hold these medical receivables in a special purpose entity. And I'll go into a little more detail later about those specifics of how the actual investment is designed. But again, there's this cash flow gap. So what we're able to do is extend that credit, settle those cases, bring that revenue into the special purpose entity where we raise a set amount of money, and then we're able to hold that collateral. And we do that by putting a lien, just like you would do in a piece of real estate with a bank. They put a first position lien on that property, right? So if you get a line of credit or a loan, the bank always wants that first position. So that's what we do. We underwrite those receivables and make sure that we have the first lien position, letter of credit, oftentimes with the UCC1, for those of you that are familiar with that. That's basically just locking down that medical service provider, those assets that they hold. So we are able to be sure that we're going to get paid. And paid by whom? We're going to be paid by those AAA rated insurance companies. So that's the process and how we actually extend that credit and how we secure it. So everybody really wins in this process, as I've already mentioned. I think in the investment world, especially alternative investments, we know time kills deals, right? And there's also this time value of money. And in this type of investment that we are able to provide, we are actually able to give investors a high yield, predictable, annualized return that we pay quarterly. So investors are happy. Medical providers are happy because they are not waiting as long, right? Sometimes we're accelerating that process, the settlement process, under 5 months typically. So that's something to keep in mind as well. So they're getting paid more promptly. Attorneys also like it because they're the big winners actually in the personal injury space. They get paid often 30 to 40% of a settlement. The longer that settlement takes, that value continues to decrease. So they love us because they know we're very efficient. And our track record is nearly 10 years. I'm going to talk a little bit more about that. And of course, the patience. This is the part that I really get excited about because there are a lot of investors out there, like you and I, that are very passionate about a certain asset class. I would share with you that in the medical space, there's a lot of investors that are doing investing in startup companies, med tech companies, and they're very motivated by patient outcomes because what's going on out there is really not good in many scenarios. So innovators, people that are very solution based. And what we do is we're able to get a better patient outcome. Why? Because the medical provider is not distressed. They're able to focus. Again, locking arms with the bank, PFD capital management. And what we see is really a better quality of care throughout that patient's recovery. And that's a short way of saying and explaining a very complex industry and I would say challenges that are out there. For those of you that are doing maybe passive investing, a lot of times, especially if you're thinking about note investing or promissory notes and that collateral behind that note, often that is a distressed asset, or it could even be a non-performing note. So that can be a little bit more risky. Some people are very comfortable with that. They like the distressed asset and they know how to track that and work with that investment sponsor. And if they get that a distressed asset, it doesn't really bother them. But that is really not what we're talking about here. We're talking about truly passive income. The heavy lift and the hard work that you need to do when you are looking at this opportunity is upfront. Who are the people in the deal? What is our track record? Where did we come from? How did we get here? How are our investors doing with us? Are they happy? So I can talk a lot about that one-on-one, and I hope that you will schedule a call with me so we can talk about that. But this is the heavy lift in the beginning. But when you place that money, we have a 3-to-1 collateral minimum going in. So those assets inside of that entity that you're investing in, it's a 3-to-1 collateral minimum. We often are at 4-to-1. So what I mean is we extend a line of credit to a medical service provider, $1 million. We're going to lock down $3 million in personal injury medical receivables. Hopefully you're all following me on that. So 3 million in value. So that is the value of those settlement cases. And we are often getting 1.6 on each dollar when we settle. Okay. So that's the asset, highly valuable, not distressed. We've been doing this for nearly 10 years. We have not missed a payment to our investors. And it is a high yield income. It is double digit. It is also consistent and predictable. And it is tax advantage for those of you that are using a self-directed IRA. You can use your self-directed IRA, you can also use cash, and you can also do a combination, which we can talk about one-on-one. The big thing that I always like to emphasize is that we control also all the levers in this deal. What do I mean by that? When you're investing in real estate, for example, syndication, even in oil and gas, there's a lot of operations, there's a lot of management going on, excuse me, in the asset. We are the PFD family of companies. And so we have a statusing company like a property management company or operating company that you're not exposed to at all. You're in a special purpose entity. That's where your investment and your dollars are sitting. And just think of it like gold bars. We're just stacking that value over time, and all the revenue from those settlements are going into the company that you own, increasing that collateral month after month, year after year, up to 5 years. In the example of real estate, we've got different levers in that deal, right? You've got property management, you've got vacancy, you may have interest rates, you may have debt leverage. You don't have any of that with this particular investment. We control all those levers because we're doing the statusing and the operating outside of the entity and the investment that you are making. And we are not correlated to the stock market at all. And economic factors doesn't really matter to us at all because personal injury, I was actually reading some of these statistics again this morning. In 2023, 62 million people went into a medical facility for injuries. And Florida leads the nation in personal injury cases per capita with 1,237% more filings than the national average. So if people stop driving cars and stop getting into car accidents, and maybe we've got a problem, right? And insurance companies just go away with how they're doing personal injury, which is highly unlikely. So that is a really important thing to come or to keep in mind when you're reviewing this investment. I also want to keep in mind here, Invest IRA. So I'm an individual, unbiased advocate. I am a consultant. I work with custodians like Camaplan, and it's always my pleasure to connect with you as clients or prospects with Camaplan. So we are here to help you navigate those decisions with your IRA together here. I also have other opportunities that we're not talking about today that are passive income for those of you that may not be accredited. But this is the income test. Most of you may be familiar. I do run into a lot of wealthy people that really did never even heard the term, which is I always find kind of fun. But you want to just take a look at this slide and make sure that you qualify. This investment is a 506C Reg D. And we have, of course, that exemption filed with the SEC. On EDGAR, you can always put in PFD select medical receivable. We're on 1020 right now. We just closed on 1019, our previous fund that actually funded in 30 days. So that is quite outstanding. We have fumbling here. We have investors across the country in 47 states. We have over 1,800 investors that include some family offices and institutional funds. And we have actually completed at the end of Q4 of 2025 over $80 million in distributions, which is quite impressive. I'm going to tell you a little bit about our story here and then go into the structure of the investment a little bit further. I mentioned to you that I've been in the industry. It's been 8, 9+ years. I'm losing track of time. But in 2020, of course, we couldn't travel to do events. I used to travel 80% of the time going to live events to explain the self-directed IRA process and how to get that account open and funded. Loved it. But in 2020, of course, we got shut down. We couldn't travel. What are we going to do? And I got on Zoom and started doing events like this. And that's when I met PFD Capital Management. And they were at that time maybe 100 investors in 2020. So you can see the progression in just 6 years. What I loved about working with them was the fact that they were just real people, hardworking, very transparent, and very motivated, very excited about what they were doing. And this is why. The partners that founded PFD Capital Management, did the workman's comp settlements for the state of California. And that was no small feat for them to be doing. So that's what they did. The state of California came to them and said, personal injury seems to be growing and kind of an issue here. Can you guys do it? And they said, well, I don't see why not. So what they did is they took their own money in 2014. It was about $1 million, a handful of investors, and they worked through this business model to be sure that they were able to pay their investors. So a lot of people say, hey, have you ever had a time where you couldn't pay the investors? Well, there was a time in those 2 years when they were not exposing outside people like you and me, where they were delayed a little bit in paying those returns. But they worked out the kinks. And in 2016, so for 2 years they did that. And then 2016, they opened it up to investors like you and me, put it into our 1000 series, it's called. And we started with 1001. It's a little boring, but that's what it's called, 1001. And now we are on 1020, so 1020. And we raised $10 million at a time. And each unit, this slide here actually is a little bit redundant, so I'm going to kind of just go over this because I'm going into the story a little bit here. But that what I wanted to point out is that they were able to go from 1001, like I said, to 1020 today, but raising $10 million at a time, paying our investors again annually, quarterly, and no ramp up, no waiting period, and often turning that $10 million into 30 and sometimes $40 million. So for those of you that qualify, you want to take a look at our investor deck. I'm going to show you that pro forma. We're going to walk through that and you'll be able to see what we do. So when people say your double digit return is too low, and then they see what we're actually able to do with $10 million, they're like, how do I get a piece of that at the end? The equity. Well, we do have opportunities for equity as well, but you have to be in our 1000 series first. And then we talk about our 3000 series, which does have the equity component in medtech companies. So I talked a little bit about the 3-to-1 collateral. So you've got that asset protection. You've got a fixed quarterly yield, and it is annual, predictable, paid quarterly. It is a 12-month lockup. And what that means is after 12 months, if you needed to redeem your capital and earnings for any reason, you can do that with no redemption penalty. That is very rare. The term is always 5 years. So let's say you put in $100,000. Let's just put it this way. If you keep your money, all those dividends and returns inside of the PFD fund, the 1020, for example, and you did $100,000, you're basically going to double that in just 5 years. That's how powerful the returns are. So you will be getting compounding interest on your earnings. And we always buy you out in year 5. So a lot of our earlier investors back in 2016, of course, have exited those funds. And so that's one of the reasons we're raising money more quickly, because they're like, hey, we want to keep our money working for us. So they just go into the next entity or the next fund. So that's what the investment looks like. So Matt didn't talk too much about the self-directed IRA. So those of you that may be new to the conversation, it's pretty simple. When we're sitting in the seat that Matt's sitting in, it is simple. You're going to open an account. You're going to get comfortable. You're going to talk to your Camera Plan specialist, and they're going to explain that process, and they're going to help you open and fund that account. And then with your account, you're able to look at the PFD opportunity or others that we may have on the plate at Invest IRA, and you can start receiving that passive income, double-digit returns immediately. The minute that your money hits the fund, you are earning. No ramp up, no hold period. It is so lovely. So our clients are enjoying this, and we also are able to, again, be transparent. We have a lot of client testimonials that we can share with you. We even have a hotline where we have our clients call in and just have them share, how's it going? So we can share some of those testimonials as well. People that have been with us since the beginning. And we also encourage visits to Irvine, California. So you're welcome to do that. And the other thing that we do for our clients, we just started that this year, is we do have a quarterly webinar that we go over all of the performance at PFD and just give you those updates. We also do quarterly calls, individual calls to all our clients. It's taking a little longer than it used to now that we have 1,800 plus investors. So self-directed IRA, why do we do it? Well, we do it for tax advantage, right? So a lot of people ask me about depreciation. Do we have any depreciation advantage with PFD? No, you don't. It's passive income. It's a tax return on your K1. Can you do it with the self-directed IRA, those small business plans? Absolutely. Can you do it with an entity or cash? Can it be in your name or joint tenant with your spouse or other? Absolutely. So love that, this traditional retirement income when you're really disciplined, like a lot of investors are. We know that the stock market has some advantages, and we also know that there's advantages and alternatives. Right now, we're also seeing a trend where real estate, it's a whole nother world. So I'm not going to get into that too much, but there's volatility there in different ways. But there's also a lot of opportunity in real estate right now. It's just going to look a little bit different. I want you to think about specialty medical finance, or PFD, medical receivable investment, as this, again, maybe that lazy capital or the capital that's in between the deals. We don't want you to think of it like a bank account. However, you do have that liquidity after 12 months. So that is something to keep in mind. So if you want to get your toe in the water with us, you can. Each unit is 100,000. We do 10 million at a time in a raise. So 100,000 is per unit. The minimum is a quarter of a unit, 25,000. And you can start that way, and then you can always add more capital, which is wonderful. You can do that up to 2 years. And I often find people doing that a lot. So true passive income, as I talked about, and uncorrelated to the ups and downs, of course, of the stock market. So next steps for you, of course, is to reach out to Matt if you do not have a self-directed IRA, or to myself. I'm happy to review the CAMA plan fees with you as well as we talk through this opportunity. Whatever works for you, you can schedule a consultation. We do have a third-party accreditation verification process at PFD Capital. We are fully audited. So annually, we have a lot of transparency. We dot the I's and cross the T's like no other. We have a very strong team behind us. So that accreditation process is third party. It can be a little clunky, but I can help you with that as well. I can also help you getting that account open and funded if you need that, and start earning that income. I do have a QR code there. You're happy. I'm happy if you take a picture of that and you go ahead and schedule some time with me. And you can always text me. Some people are like, you really give your phone number? I'm like, yep, I do, because we raise money fast. So if you're interested and you don't see a time there that's available for you, feel free to text me. I do appointments outside of the schedule that you'll see on the QR code. So I think I covered most of what I wanted to cover. Hopefully that made sense, Matt, for everyone. And I haven't been looking at the chat, so hopefully you have, or the Q&A. So
Yeah, we did have one question come in, so thanks for going through all of that. That was great. Um,
good.
the question, I have some questions, but one of our participants asked, what are some of the risks of this investment?
So the risks. I think with any investment, the risk is that nothing is 100% guaranteed, right? But what you really want to look at is the past performance, but you also want to dig into the individuals in this PFD management. And the risk, like I said, is people stop getting into auto accidents. The insurance industry, this personal injury space is about a $60 billion industry. And we have about 11% PFD of that settlement process market. It's significant. The industry is very fragmented because there are a lot of companies that do what we do, but they do it by county or city. or maybe a particular state, or maybe a certain modality of medical care. We are very different in that regard because, again, the experience of managing workmen's comp settlements for the state of California is profound. And so they were able to translate that experience and bring it into the medical space and then grow that across 14 no fault states, which is remarkable. And we also, in the portfolio where we hold those assets that I talked about, those personal injury receivable assets, it's a blended portfolio. It's not one physician, it's not one hospital, it's blended. So we're mitigating risk, and we have a very meticulous, rigorous underwriting process because the asset is most important. We care about the medical service provider in terms of their credit and their assets and the things that they want to do. But unlike a bank, we're not really underwriting that credit report. We're underwriting the asset. It's going to be paid by insurance. It's not a matter of if it's going to be paid. It's a matter of when.
So
So
that's actually, so someone asked a question directly related to that last comment, and they said, "What if the
yes,
insurance company does not pay the receivable in full? Who pays the lender or line of credit fund?"
right. So we extend the line of credit. So that is, we really have built up these assets over time. So we have kind of vacillates between about 1.5, 1.6 billion assets under management. That's how much we've grown. And we're deploying 40, 50, 60 million that we're deploying on a continual basis. So there's no issue or bottleneck on our end to be able to extend those lines of credit. But the securing of that asset is really or securing of that line of credit uh, is really based on that asset, the underwriting of that asset. It's also overbilled. I know many of you have had medical treatment, and let's say you go to get an MRI, you go to the hospital, for example, that might be a $20,000 bill. If you go to an MRI med center, right, imaging center, that might be a $10,000 bill. Or I'm sorry, that might be even a $5,000 bill, right? So there's room in that billing, and it's never going to be paid 100%. So that's a good question. It never is. But the faster you settle, which is our expertise, that's our operating company, that's what we know how to do, 10 years of doing it. The faster you go, the more money everyone is going to receive.
So maybe you cover this, or this is just from my understanding, because this is a very unique investment.
Yes,
There's the care is provided, right?
yes,
And it is billed for, and um, that bill will ultimately get fulfilled. At the end of the day, it's going to get fulfilled or paid by the insurance provider. But
yes,
exactly how much will be paid is kind of that has to be settled, and that's settled by
correct,
PFD. So
correct.
um, so just using kind of like the numbers that you said, I think like $20,000 at the hospital, or we'll just say $10,000 if you went to an MRI imaging center. Um, how much is PFD uh, providing in the meantime if there's between the $20,000 billed amount versus the
Mhm.
lower end of the spectrum, $10,000?
Okay. Couple things. One, the personal injury medical receivable, that bill is a legal binding hard asset that is going to be paid by triple rated insurance companies. We don't take anything that's not backed by a triple rated, A rated insurance company. That's number one. Two, we're extending a line of credit. And so what happens is a lot of people think of this as an individual doctor, an individual bill. But what we're doing, just like in the note space, let's say private notes, promissory notes, note school, right? You're getting a blend of notes in the portfolio, right? To keep that portfolio strong, because some are going to settle higher and some are going to settle lower.
Mm, okay.
But our record, we're tending to get 60 cents above the dollar, right? So 1.6.
Yep.
And I think this is also back in 2023. So the average personal injury settlement is about $52,900. So when you're deploying $10 million to acquire these assets, we're not buying a distressed asset. And in some cases, we're not even buying it. We're locking it down with a first position lien letter of credit, like a bank. So when it's settled, that money, that revenue is coming directly to PFD, going into the fund. It's not going to the patient. It's not going to anyone else but us. And we make sure there's nobody before us.
Okay. And the borrower in this case is the medical service provider. Is that right?
Exactly.
Okay.
Exactly.
All right.
And
Um,
they love us.
so we had two questions from the same person, specifically about the investment. So about return projections of the investment. So I don't know how much you're willing or able or comfortable sharing,
Yeah,
but
if you're comfortable with me sharing exactly
yeah,
what the
it's
terms
fine.
are, that's
So
good. Yeah.
yeah,
So
first question is what is the annual return percentage, and second question is what is the investment minimum?
great. So the annual income is 15%. It's paid quarterly, 3.75% per quarter. If you keep your earnings inside of the fund, you can receive it, your earnings by check every quarter, or you can return those earnings back into the fund. If you choose to do that for the full 5 years, so in the example that I gave earlier, 100,000 becomes just over $200,000 in 4.8, basically 5 years. So that's the return, 15% paid quarterly, 3.75. And the term is 5 years. And I'm sorry, I forgot the second part of the question. Was there another part?
Um, and then the what was
Oh,
the
the
minimum?
minimum.
Yeah.
Yeah, the minimum. Thank you. So the minimum is $25,000. So each
Okay.
unit, so it's $10 million. And this is important too. I don't think I mentioned this. So all of the investors, so we have 99 investors like you and me, right? 99 per fund. And you are the preferred paid B member share, which is huge. We take zero. PFD management is the manager of that fund, the A member. They take zero out of this investment until year 5. So you are paid like clockwork, 15% preferred paid. And as we're building that collateral, adding revenue, right? Our cost of money is actually going down because we have so much money coming in, increasing your collateral, but you are preferred paid. So we're always giving you that 15%. And then in year 5, we buy you out. If you do have an odd amount sitting in your IRA, I just want to mention, so sometimes I can make an exception because if you want to get in and you've got some money in between, it's just shy of the 25, don't hesitate to reach out and ask about that.
Awesome. Just typing out an answer to someone. Give me 1 second, Mark. Perfect. Thank you for answering all of that. A couple questions I had going to that. I think you said it was 120 investors in 2020, and then you climbed up to 1,800 as of today. Are those numbers right?
Yes, those are approximates because we have our quarterly meeting next week. So we had a call yesterday, and so I don't have all the exact numbers. But I do recall when I first met PFD, it was a very small number of investors. But I can get exact numbers, but I think we're actually closer to 2,000 investors. Keep in mind, this is an institutional grade investment. So if you talk to brokers, advisors out there, just like they talk about real estate investment trusts, REITs, and different things, or medical or private equity, and they say, oh, you've already got it, it's in there. Well, that's true. I mean, they have products like this, investment products in those types of institutional investments. The difference is that you have zero control over it, right? So it's not an alternative asset that you're moving away from the stock market. This is truly something alternative. And we have made it available to the retail investor, which is huge. And of course, that gives us flexibility and more power to do what we do and do it well when you're not dealing with a cumbersome, you know, bank process, which I know everybody knows about as an investor. So I hope that makes sense. But this has been out there for a long time, but it has not been available to retail investors until just a short time, about 10, 12 years.
So, um, related to that, I think you kind of answered the question. Is I was gonna ask like 120 up to 1800 is like it's like a rocket ship
It
going
is a
up.
rocket ship.
And so, and I was gonna say like what contributed to that rocket ship, and it sounds like availability is the kind of the main theme. I'm curious. This is pretty niche, and you have experience working with IRA investors. Probably see the same patterns that we do, which is a lot of people are investing in real estate. How do you kind of see what are sort of the I guess I'll call them hangups, but what are the learnings that or aha moments that investors have about this that you see happen that get them, comfortable with it, especially as they're thinking about other ways to diversify their portfolio?
So the aha moments for self-directed IRA investors, I really hear a lot from current clients that I really love this because I don't have to think about it. I get a quarterly call. I get information from you. I get information from the team. And I get this check, and I see this on a regular basis. And they just go, wow, I just really like this because I can set it and forget it. And that really is true passive income. And I think that's what I hear probably the most. As far as the growth and kind of the rocket ship that you're talking about, I've seen it more so in the last even 24 months or less. And one of the reasons for that is because our earlier funds closed, right? So people
Mm,
are getting their money back. And then they go, wait a minute, I'm not done. So they're putting it into a newer fund. So I think that is one of the reasons we're seeing acceleration. We also have other funds that are available that are, again, institutional grade, meant for institutions. And so we can do feeder funds or fund to fund. So we do have family office money. So they're doing, millions of dollars at a time. So that's bringing up those numbers as well. But the word's just getting out and we have a lot of traction. So, and I can understand as an investor myself when you see a lot of growth. We've all seen it out there. There's Ponzi's, there's stuff out there that just makes us shake our heads. People into the 40, $50 million and they're not paying their investors. You have got to really look at the structure and the legality of the binding agreement that you have with PFD, and having a preferred paid member is a thing. That's huge. That is our legal responsibility to pay our investors first. We have no right to those funds until year 5.
and
And
that's you said that's written in the that's a part of the initial.
investment document, right?
Yeah, yeah,
Your
okay.
your PPM and
Yeah.
operating agreement. Yes, our agreement with you. So that's a big deal. And I listen to a lot of investors and podcasts and things like that. And um, I was listening to a billionaire, literally, an attorney, but I won't go into that. But anyway, he was talking about this, how he started businesses more conservatively with private money because he didn't like debt, right? So he did like these 8 and 10%, which was very generous 30 years ago
Hmm.
and still generous today. Um, but he was talking about how he structured these funds to get investors before he actually deployed money into the investments. He would gather this money and he offered this preferred paid arrangement, which made investors feel more comfortable because you're not sitting there waiting for things to happen. You knew what the commercialization looked like, or you knew what the investment activity was going to be, an equity event.
Yep.
And you may or may not have equity, but if you had that preferred paid, you understood that preference, and that is a big deal. And a lot of people just don't know what to look for because they're doing investments with friends, family, going to events, they get comfortable. Um, I've done it, startup companies, but you kind of hope and hold your breath and, you believe. But here, this is in black and white. And we encourage you to run that by your team, whoever those advisors are. A lot of the brokerage or advisory firms, they're cautious, but I've also seen a little bit more receptivity from advisors, meaning when they're managing a lot of money, they understand they're going to have investors that are going to do alternatives, and they know that that money's coming back to them. It makes no sense for them to be defiant about it. But I think it's good for them to take a look. I often talk to advisors as well with my clients, and I think they're seeing the trend.
All right. Great answer. Let's see. Two, we had three questions. So the first question is, I'm going to read it verbatim. You talk about asset a lot, but this is not considered owning an asset like real estate, so you can't transfer money selling an asset to this. So you
Correct,
can't transfer money selling an asset to this for tax advantage, leaving capital
correct.
gains. Yeah.
Correct, correct. And the reason I use real estate a lot is just from a collateralization discussion
Hmm.
and also from a revenue um, distressed asset. In my example, about 100 doors, 80% vacancy. I think it's relatable, right? So the doctor, if they've got 80% of their patients not paying, that's a burden. So we come in and solve that problem. And then as far as the real estate example on collateral, I think gold bars is a great way to look at this too. When you invest in gold, as the prices change, of course, that's related to the economy, right?
Hmm.
But that value of gold is going to go up and down. But bars are gold bars. You're going to keep, stacking those if you choose. We know that it's going to have staying power and a predictable value by looking at history and performance. So these personal injury medical receivables have exceptional value, right? So they're not up and down in your eyes because it's a preferred paid, 15%. We're just managing that value and we're just adding to it all the time. That's the
Uh,
collateral.
okay, perfect. And then that same person said, do you take stable coin payments or only fiat currency?
uh, we just take cash,
All right, yeah. Well, I guess
cash and IRA.
that'll be that maybe that's something to consider for the 2027 plan.
Well, who knows? Who knows, right? This world is changing fast, that's for sure.
Definitely. Um, and then questions are coming in, so this is a nice thing.
Great.
Uh, does PFD accept institutional money now, or will they in the future?
We do. And that's an individual conversation I'm happy to have.
Perfect. And then from that same person, is there an exit strategy for PFD, such as is there an exit strategy for PFD at this time?
For the company as a whole,
Yeah,
um,
such as being acquired or an IPO or something.
well, big money's coming for us, that's for sure. And we do have another series of funds. That's our 3,000. That one is a blend of the medical receivable that I'm talking about here. And it also has three med tech companies in it that are through FDA approval. One of them does have revenue in our comfort study. The industry that we're in is in the Alzheimer's stem cell delivery for the reduction of Alzheimer's and also prevention of memory loss. One is a wound care healing product, Casderma. And then also we have eye orthopedics, which is an eye knee alternative to a full knee replacement. I can talk about those more one-on-one. The reason I mentioned that is we've done this fund intentionally because we have the expertise, number one. Eric Hansen is the one leading our healthcare division. He's the one that actually makes the quarterly calls too. We're very, very personal. But he's a very busy man, and his background is merger acquisition and also running teams in the medical space. And we will have commercialization events with that fund. So once you're in the 1000 series, and this is a little bit of like the exit strategy, and this is the reason I mention it. In that type of a fund, you're waiting for that commercialization event. So people that are familiar with this, in the medical space, the heavy lift is upfront and it's very costly. But once you get through that, so we provide that funding for the research and all the things that have to happen before the commercialization event. And so we're anticipating that actually in one or two of those within the next couple of years. And we're raising 75 million on that. So that's also another opportunity. The exit is really the exit, right? You're exiting those funds. So PFD will go as long as there is a demand. And we're not reliant on any individual person per se, because we have the structure and we have a very
Mm-hmm.
diverse team of
Mm-hmm.
experts. And you'll see that in our private placement. You'll see that in our organizational chart. So we're not like a typical, it's not even like a family office or some of the real estate businesses that I've seen that are smaller, but it's not like, oh, what happens if so and so, dies. It's not like that. They're funds, we're running funds.
Perfect. And since I know you have a hard stop at 1, you have a call at 1, and
I
I want to give you
do.
time to like transition from this to
Thank
that.
you.
We have two more questions, and those will
Sure.
be the final questions that I ask you to answer. So I'm going to say this to everyone now. If you're watching and you don't get your question answered, reach out to Roberta. Contact information is in front of you. With that said, here are the two questions. How shall we follow your company's? Actually, I'm going to say that question second because it's a good closing question. First
Okay.
question is, can you clarify the quarterly returns versus participation in fund equity when the fund closes out? How does an investor participate?
Okay, great. So just to keep it separate, in the 1000 series, which we talked about mostly today, is the 1020. And so that is a 15% annualized return paid quarterly, 3.75. So that's it. The term is 5 years. And we talked about the liquidity and the ability to add up to 2 years. The 3002 series has that accounts receivable component, but it's a 5% annual. So think of it as like I'm investing in a med tech company, like a startup with some legs, right?
Hmm.
And so I invest there, but we're going to give you that 5%. So you're getting some returns while your
Hmm.
money is deployed. It's going to be a 5 year term because of that account receivable that I talk about in the 1000 series. The difference is you're going to participate in the equity event in the 3002 series. And that we're expecting a 9 to 15x. So it's substantial and there's more to talk about in that. But that commercialization could happen, let's say in year 3 or 4, or it could happen in year 6. Doesn't matter. Your capital is going to be returned with your 18% because there's a blend in there, and I can explain it one on one. Your worst case scenario in that is 18%. Your best case scenario could be as 15 times your money.
Okay. Good to know. So the person who asked that question, great question. I would say if you want to go deeper on that, schedule a call with Roberta. And then the
Yes,
last question is, how shall we follow your company's news or insider information, just so we can
sure.
know ahead of if the company's going through tough times or what's to come, things like that.
Absolutely. Well, the first step is definitely to reach out to me. I'll get you some information to our investor deck, and I'll be able to send that to you. And then from there, you will see newsletters and you will see information. I also, with Invest IRA, do different topics and things. I try not to bombard people, but I'll keep you informed once you connect with us.
Perfect. All right. Thank you very much, Roberta. Great presentation, and thank you everyone for asking all your questions.
Yes,
That is not as common as I'd like it to be. So everyone, you rose to the occasion today. So good job, Roberta, for inspiring
thank
those
you.
questions, and good job, participants. Pat yourselves on the back. Um, the recording will be sent out either tomorrow or early next week, but we'll send that recording out to everyone. And then if you have any questions, please use the contact information in front of you to reach out to Roberta. Any closing comments, Roberta, that you want to share before we sign off?
Well, mostly, thank you. I really appreciate it. It's great to be here, Matt. I was looking forward to this, and thank you everybody for joining us. And I really do encourage you to just check us out. I don't think you have a thing to lose to learn more. So, and I look forward to it. So, thank
Beautiful.
you.
Thank you very much for presenting today. Thank you everyone for joining today's webinar, and we will see you on the next one. Have a great rest of your Thursday and a great week. Bye bye.
Bye. Thanks, everybody.